All right, guys, warm welcome to a brand new week. Now, apart from Russia-Ukraine issues, tensions going on between the two countries. Apart from there's still a lot of focus on the synchronized policy tightening taking place by major central banks around the world. Apart from that, our focus from a currency pair point of view for the week ahead will fall back to the Aussie CAD. Now, as you guys know, we've maintained a bullish bias for the Aussie CAD for the last couple of weeks, in line with our trade idea that we posted on the 1st of February. We entered into this trade on the long side from just after the RBA meeting on the 1st of Feb, from around the 89.80, 89.90 region. Now we've taken profit twice on this trade, the first one at 90.60, the other one at 91.10. Right now, we have one unit remaining, running with stops at break even and looking to actively engage this, scaling into this trade, either with pullbacks into key support levels or possible breakouts and retests to the upside. Now, why do we think there is still such quite a lot of room still to the upside, catch-up potential to the upside for the Aussie CAD? Well, firstly, let's see what's been priced in for these two central banks. Now, one can argue that with both the BOC as well as the RBA expected to hike rates over 6 times this year, one has to argue that, okay, maybe enough has been priced in. There isn't really a lot of policy divergence potential between these two. Now, even though looking at this at face value, one can argue that we do need to keep in mind that, if you compare the BOC and the RBA's recent response, their overall policy stance, the BOC has shifted hawkish, and stir markets have obviously been trading in line with that. But if you compare that to the RBA, the bank is yet to shift hawkish, right? Yes, they've moved away from yield curve control in November. They've now officially ended their quantitative easing program. So they have incrementally moved away from ultra dovish policy, but they haven't tilted hawkish just yet, as the markets are expecting them to. And for us, that means that there's still a lot of catch-up potential between these two. Now, if you just quickly compare the performance of the CAD versus the Aussie, we've got the CAD here in pink. This is a currency index that we've built in TradingView, and the blue one is an Aussie dollar currency index. And we can see that, based on this alone, based on what's been priced into stir markets, the Aussie dollar is yet to reflect any type of policy tightening, while the CAD has been pricing in policy tightening for quite some time. We're also seeing a very similar situation playing out for the Canadian dollar right now, just like we had back in April as well as October 2021, where the markets priced in way too much too soon, only to see a lot of those gains being unwound. And we think there is potential for that to happen in this case as well. Apart from what's been priced into stir markets, we also think there is a potential economic/policy divergence setting up between these two countries. Now, as far as the economies goes, we think there's a very interesting dynamic here in play between the two, between Australia's top trading partner and Canada's top trading partner. If we take a look on the left-hand side, we can see that China is, of course, the biggest trading partner and export destination for Australia, with close to 40% of exports, according to OEC data on the screen from 2019. Now, from the fourth quarter of last year, the PBOC has embarked on a lot of stimulus and easier monetary policy. They've basically cut various rates over the course of the last couple of weeks. And after a treacherous economic slowdown last year, the Chinese economy is expected to recover this year, which should be a positive on balance for Australia, since they are their biggest trading partner. Now, compare that to Canada on the right-hand side here, where their biggest trading partner is the US, with over 70% of exports. And in the US, the Fed has recently embarked on a very aggressive tightening cycle. So, on the one hand, your biggest trading partner over here is going through an easing cycle, expecting their economy to recover. On the right hand side, you've got the Fed that is embarking on such a massive tightening cycle that right now it's expected to add quite a lot of pressure to the growth in the inflation outlook, which was already expected to slow going into 2021. We can see how the markets are thinking about that growth outlook right now, where if we just take a look at this orange chart, we can see the 2s and 10s yield spread. We can just see the massive move to the downside as the market is pricing in a much more negative outlook for the growth and the inflation side for the US economy. So on the one end, you have Australia, where their biggest partner is currently busy easing and their economy is expected to recover. At the opposite end of the scale with the CAD, you have a lot of outperformance last year, and that is expected to slow and now potentially slow even faster than previously expected, given the tightening cycle that's being brought in place by the Federal Reserve. So that obviously creates a little bit of a potential economic divergence between both Australia as well as Canada. Guys, just give me a second. All right, sorry about that, guys. So the other one to look at here is, of course, commodity prices. Now, there has been a lot of upside recently playing out for WTI, and that is, of course, a very important input for the Canadian dollar. The one thing just to keep in mind, though, is that even though if we add in WTI here for a second, even though there has been that big divergence between WTI and something like Aussie CAD, which does suggest that there can be some catch up to the downside, even though that is the case, I think it is very important here to keep in mind that even though oil is an important driver for the Canadian dollar, it's not the only driver for the Canadian dollar. And when we take a look at something like the Aussie CAD more specifically, if we go to a higher time frame, let's say we go to something like the weekly here for a second, we can see that that correlation, even though it does hold, it does differ from. There has been times when that correlation has been very strong. It's hardly perfect, right? It's very much a hit and miss over a very, very long time frame. And that means that even though oil prices is a concern and it is a downside risk for the Aussie CAD, it's definitely not something that's keeping us from trading this currency pair right now, because we do think despite what's happening in the oil market, there is still upside potential. Apart from that, if we consider the commodity front, on Australia's side, remember that the two biggest exports for Australia is coal prices and iron ore. And even though the same argument can be made for these exports compared to the Aussie dollar's performance, the medium-term expectations and trend for things like iron ore and coal prices is looking slightly more attractive right now, given China's expected recovery this year. If you take a look at this chart, I've basically marked out the rapid turn that we've had in iron ore prices from last year. And it all started with rumors from the PBOC that they will start cutting rates. It turned from rumors, that turned into the first triple R cut. We had more rumors that turned into a first LPR cut. Then we had the step up in open market operations. Then they cut the MLF. Then they cut both the MLF as well as the SLF. And more recently, we've actually seen them actually coming out buying stocks to try and prop up the stock market. So that stimulus has been a key driver for those commodity exports. And as long as that stimulus stays in place and China's economy is expected to recover, that should place upside pressure in these commodities, which should be more supportive for Australia, considering that, if you think about exports, we already know that 40% of exports goes to China. Now, of that 40% that goes to China, iron ore and coal makes up about 40% of total exports, right? But China, of that 23% of iron ore exports, China takes 81% of that and 18% of coal. So, the two biggest exports really relies on China, and if their economy starts to recover again, that poses some potential upside for the Australian dollar on the back of that. Now, apart from commodity prices, the other thing that we've been looking at for quite some time, of course, is the positioning. Now, right now, if we take a look at where positioning is at, the Aussie dollar is still sitting on the biggest net short among the major economies. And we think that despite what's been priced into the stir markets in terms of interest rate probabilities, despite the incremental shifts from the RBA, that net short is still massive right now. And we think that there's still a lot of room for some of those net shorts, those big net short positions, to start unwinding in the weeks ahead. We've actually been very surprised that after the recent developments, that those holding the big bag of shorts haven't really been motivated to trim down on some of their risk with those short positions. But given positioning alone, comparing the Aussie versus something like the CAD, we do think there's a lot of catch-up potential on that front as well. Now, apart from apart from commodities, apart from positioning, apart from the possible economic divergence, as well as what's been priced into stir markets, the other focus, as always, is what does the bond market have to say about all of this. Now, if we take a look across the curve, whether we take a look at tens, whether we take a look at fives or twos, we can see quite a divergence right now between what yield differentials are showing us and what spot prices are showing us. Now, it is important to acknowledge that yield differentials alone doesn't necessarily mean that spot prices must catch up with what yield curves or yield differentials are showing us. But we think it's quite interesting that despite both banks expecting to hike rates more than 6 times this year, that there is such a big divergence in the differentials alone versus where spot prices is trading. And in a nutshell, for us, that means that right now the Aussie dollar on multiple fronts is looking very undervalued versus that of the Canadian dollar. Now, what is the trade? What are we looking at? How are we looking to potentially trade this? Well, we are already in this trade from the 89.80 level, 89.90 level, and we are looking to actively either add on pullbacks or potentially add on breakouts to the upside. Now, there's a couple of possible catalysts that we can look at to trade around that. If we take a look at possible bullish catalysts, so i.e. things that we'll look to potentially add as an at-market entry to the upside, is if we have a big beat in Thursday's jobs data. Right now, consensus is expecting the Aussie jobs to come in with a little bit of a contraction due to Omicron back in December. So if we do get a surprise beat coming out of that data, that should be supportive for the Aussie and obviously supportive for the Aussie CAD. Apart from that, given that Australia, or the Aussie dollar rather, is considered as a favorite risk proxy among investors and traders, any de-escalation in the current issue between Russia and Ukraine is expected to be supportive for risk sentiment, which is expected to be more supportive for the Aussie dollar. The reason why we've opted for a more neutral outlook for both de-escalation as well as escalation with Russia and Ukraine issues is because of oil prices, right? On a risk sentiment point of view, if we get de-escalation between Russia and Ukraine, that is, of course, expected to be positive for risk, i.e. positive for high betas like the Aussie and the CAD. But at the same time, any type of de-escalation should also be negative for oil prices, i.e. negative for the CAD. So whether it's escalation or de-escalation, we're opting for more of a neutral stance on the Canadian dollar, given the influence that the oil markets can have on that. And then we also have CPI data coming up for Canada. Now, a big miss in that across the board is unlikely to change the BOC's mind right now, but what it can change is if we take a look at those STIRS markets once again, it can start to price out some of that very aggressive policy expectations we've seen baked in for the CAD. And that, of course, can be negative for the CAD, upside for Aussie CAD. In terms of, so these are all catalysts on the top side that we can look to potentially add at market positions with. The ones that we'll be looking for possible pullbacks to add with is if we get a big miss in Thursday's jobs data. Again, consensus expects a contraction right now. So if we get a monster miss and that sees some downside in the Aussie, it might provide us with an opportunity to buy back at a more attractive level. Again, if we see escalations between Russia and Ukraine as a favorite risk proxy, the Aussie is expected to feel the heat a little bit more than the CAD on that front, and that can also see downside, again, providing opportunities to buy back at better levels. Alternatively, if it's just a monster beat in that Canadian CPI data, and that sees the markets implying more hikes this year, that can, of course, be positive for the CAD in the short term, negative Aussie CAD. Again, we'll use that as opportunities to get back in at more attractive levels. Now, the markets or the levels that we're looking at for possible either breakouts and retest or potential pullbacks is firstly that 90-60 level. It acted as such a key area of resistance over the past couple of weeks. After breaking above that, we do think that the market should be able to base around that zone. So 90-60 would be a first one to look at for a possible re-engagement back to the upside. Alternatively, a breakout retest of either 91.10 or 91.50 both looks interesting here for some potential scaling in opportunities in the event of an at-market move. Maybe we miss the move and there's sentiment. If we break above and retest, that can also open up some opportunities for upside. In terms of current stops, we do have the remaining positions sitting at break even, but for new positions, we would most likely look to add just below that major swing, just below that 89 psychological level, which is, of course, key resistance or key support going back all the way to 2019. So we would like to anchor any additional entries, stops just below that level to keep them safe and out of the way, giving us a little bit of room to breathe, especially in this current context with the ongoing issues between Russia and Ukraine.